Once again, we are presenting a webinar on the crowdfunding industry, and today we're going to discuss crowdfunding alone, debt offerings that are issued online. And as always, we have three experts participating in this session to share their knowledge and their experience in the securities crowdfunding sector. And so I'm going to ask each of our panelists to introduce themselves. I'm going to start with you, Eitan, and go around the room.
Great, Andrew. Great to be back here with you, and Ben and George. Great to see you guys as well. Eitan Butler here. I'm the chairman at Dalmore Group. Dalmore is a FINRA broker-dealer investment bank and also a financial technology platform. We were founded in 2005. We've onboarded over 1,000 companies and have helped them raise capital primarily online across multiple exemptions, Reg D, Reg A, Reg CF. Today, our issuers collectively have been averaging raising over $50 million per month, pretty consistently over the last year and year plus. And it's great to be here with you guys today to talk about a very important and growing segment of the online capital raise marketplace.
Thank you, Eitan. George, thanks for joining us.
Thanks for having me. Yeah, George Cook from Honeycomb Credit. Honeycomb is a loan crowdfunding platform, so we're a regulation crowdfunding funding portal. We let independently owned small businesses borrow fair growth capital from their own customers and fans. Entrepreneurs win because they unlock capital they might not be able to get from other lending sources. And simultaneously, everyday investors win because they can earn competitive returns by supporting entrepreneurs and communities that they love. We've moved about $30 million across our platform to date. We've worked with nearly 500 businesses. I've done deals in, I think it's 38 states across the country, and we're starting to scale up.
Awesome. Thank you, George. Ben, good to see you.
Thanks, Andrew. Hi, everybody. My name is Ben Lozano. I'm the CEO of SMBX, which stands for the Small Medium Business Exchange. Like Honeycomb Credit, we are a registered regulation crowdfunding portal that does one thing and one thing only. We help businesses that would otherwise take out bank loans and are looking to raise loan financing. Instead, we help them issue what we call a small business bond on our marketplace. The idea being that large corporations historically, when they're raising loan financing, have had access to two different sources of loan financing. They can either take out private equity or issue bank or take out bank loans, or they can also issue bonds on a Wall Street bond market, NASDAQ, and so on. And so we're trying to give businesses that are looking for loan financing a second option, which is to issue a small business bond on our marketplace. So the small business bond is really just a fancy marketing term for a loan that's issued on our marketplace. We've helped over 200 businesses list about $30 million worth of bonds, and we're due to do about 12 to 15 million in bonds this year. And really are trying to make the small business bond a scalable, legitimate capital markets asset class that for the first time gives people in a community the ability to invest directly into that business and earn the principal and interest that would otherwise be paid back to the bank in the form of a bank loan. So that's SMBX in a nutshell.
Awesome. Thank you for that. So the Jobs Act of 2012 legalized securities crowdfunding, investment crowdfunding, online capital formation, whatever you want to call it. And I always found it was unfortunate that when the industry slowly launched, many people described it as equity crowdfunding, and that's really not true. There are many different types of securities. There are safes, there's rev share, there are preferred shares, and of course there's debt and raising debt capital. And in the United States and public markets, the debt markets are far larger than equity markets. So in many ways, it makes sense for the securities crowdfunding industry to participate in this broad and enormous market. but that's taken a little bit of time to generate traction. So, today we have three platforms that are very engaged in the sector, and two that specifically are focusing on enabling loans to be funded online. And I'm kind of curious. I want to ask you, George, and Ben, kind of the genesis of how you decided. One day I want to wake up and I want to make it easy for businesses to raise a loan or raise debt capital online. And we're going to start with Honeycomb, which I think is doing an awesome job. George, how did that come about? What's the background on this?
My background, this started years before regulation crowdfunding. My family has been running a small community bank in rural Appalachia for 130 years. And I grew up in the family business and just absolutely fell in love with relationship lending and working out of the branches and meeting entrepreneurs and learning about their business and their growth dreams and everything that they were building towards. And I spent most of my career doing big data, credit analytics, consulting some of the largest banks in the country. And I saw through that work how banks were consolidating. And as banks were consolidating, they were stripping out that relationship lending model. And to me, at the core, what that meant was they were trying to replace the qualitative data of meeting an entrepreneur, seeing their business, understanding their product, and they were stripping that away and trying to replace it with quantitative data. And it turns out for the average Main Street small business, there's just not a lot of quantitative data, right? Most businesses don't have a ton of operating history. There's no good central database sitting somewhere that says which is a good business and which is a bad business. And a banker in New York City has a really hard time saying which pizza shop in Iowa makes a good pie, right? It's hard for banks who are centralizing these underwriting decisions to truly understand the qualitative staying power of small businesses. And for all those reasons, banks basically have just pulled back and they're not really lending to small businesses the same way they used to. The stat I always point to is the fact that not only has SBA lending, the volume of SBA loans gone down, but simultaneously the average size of an SBA loan has almost quadrupled since the Great Recession. And what that means is just the definition of a small business in the United States, in the banking system, has fundamentally changed. So I was sitting there watching all of these changes happen. I went back to grad school, met my co-founder who happened to be a small business owner. We put our heads together and said, how can we bring this relationship lending model back in a tech-enabled, scalable way? That was right around the time that the regulation crowdfunding rules were being finalized. We saw some industry leaders working on high-tech, high-growth equity funding opportunities, as you pointed out, Andrew. And we said, hey, is there an opportunity to use this regulatory framework and bring it downstream to the 99% of small businesses that are not venture backable and really use this Reg CF model to bring that relationship lending, to bring that community banking model back in a tech-enabled, scalable way.
Yeah, that's really interesting, and I think that for years before you guys even came on the scene, government officials have acknowledged there's this huge funding gap for smaller businesses. The banks don't want to do it; it's too much work, too much risk, so they pass, and it's bad for the economy. So, Ben, you bring your own perspective to this. You have kind of an academic background, but perhaps you can kind of share, how you came to create and launch, SMBX.
Yeah, thanks. George and I definitely have some overlap, and there's some differences here too, which I think is probably framed the way we've made slight variations on our business model, even though there's a lot of welcoming similarities between the two. So, as I mentioned, my name is Ben Lozano. My dad's name is Ben Lozano, CPA. He runs a boutique financial accounting firm down in Southern California. He's still in business today, loves what he's doing. And I worked there growing up. My brother worked there. We helped a lot of small businesses take out bank loans and do a lot of growth planning. So definitely really had entrepreneurship in at that time, Southern California. It's all over now. On our minds and the people we were serving, and again, helped a lot of businesses take out SBA loans and really saw that process firsthand. How there's always one more question to answer, how sometimes the rug gets pulled at the end. There's a fluctuation in the initial quote you get versus what you actually get at the end. So definitely some room for improvement, but it was really the only option for these businesses. Flash forward a decade, I went and did a PhD at UC Santa Cruz, and was later defending my dissertation literally the day that Bear Stearns was collapsing in the 2008 financial crisis. So it wasn't a great time to go into finance. I stayed at UC Santa Cruz and worked with some colleagues there to build out a fintech research program. The terms fin and tech after the 2008 financial crisis were really coming together for the first time. I taught millennials finance after the 2008 financial crisis at UC Santa Cruz. So they're carrying around these increasingly little powerful computers in their pockets in a way that when I went to college, we weren't necessarily. They had a changing relationship to money and investing as they watched their uncle lose his job in the 2008 financial crisis, their parents lose their house because of the 2008 financial crisis, and had this understanding of finance as something that happened to you rather than something you did. And that made an impression on me. Now, back then, those kids were just cash poor college kids, hanging out, eating Cheetos, playing video games, and going to college, and then coming to my class. But today, those people are doctors, attorneys, technologists, entrepreneurs. They increasingly have investable wealth. But the question is, what do they do with it? So at my CTO, we were early adopters of blockchain technology, and Bhavesh and I started tinkering, building some things on the Ethereum testnet. A student had put Bitcoin on my radar, and just kind of the innovations that were happening in fintech, thinking back to my background, helping small businesses who just had one option to loan financing, and then seeing this and kind of expecting this new generation of investors who were going to want to invest local and social, but didn't really have an outlet for that. Robinhood doesn't really scratch that itch, although they were all registering accounts on Robinhood. So we just thought, well, what if you could build a small business capital marketplace where regular folks could invest in businesses they already know and love and share in the financing profits, so that the wealth that's created in the act of lending and borrowing and growing a business and paying taxes and hiring new people, and that sort of virtuous cycle of growth that happens when the American economy is at its best. What if we could create that for a new generation of investors and really scale that up? And that's why the small business bond is trying to become a scalable household capital markets asset class.
Awesome. Yeah, I have faith in you. So Dan and George, I kind of view the two of you as bank replacement models, at least today. I understand things change, as everything develops and evolves. Now we have Eitan, who is really a full stack platform and a broker dealer, but you're doing a lot of debt right now. A lot of the issuers are focused on debt, and maybe you could provide, your perspective on the industry and how it's evolving, the role that debt or online lending is playing within the sector of finance today.
Yeah, unlike some of the crowdfunding portals that are out there, we're not necessarily working with issuers who are looking to raise $50,000 or $100,000 as a loan from a pool of potential investors. We're working more with perpetual issuers that are setting up funds, right? Whether and selling bonds or offering debt-related investments, and we're providing them with the white label technology that allows for them to facilitate that offering, whether that's through Regulation D and or Regulation A, and in some cases Regulation CF. We look at these exemptions pretty much as tools that enable issuers to offer their securities to anyone over the age of 18 in the case of incorporating the A and the CF. So what the issuer is provided is a full all-in-one platform that allows, it's completely white labeled, that allows for them to build their own community of investors who participate in their offerings, and also includes the strategy of how to go upon doing that most effectively. So there's the technology, obviously there's the marketing, right? Marketing is critical. How do you build a community that has an interest in your debt related opportunities? That's something we have a lot of experience with. But we also combine the strategy with a number of services that really only broker dealers can provide, including giving the issuers the ability to develop and build their own captive sales force. And what that means is there are compliant ways for an issuer to get their salespeople licensed and registered with the broker dealer, which enables them to pay their salespeople commissions for the successful for facilitating the sale of those securities to investors. And that works really well with funds, right? Like, let's say I'm a $100 million debt fund or a bond issuer, and I'm looking to get to $1 billion. What are the ways that a typical Reg D fund could go upon doing that? There's the old-fashioned way of trying to call broker dealers and investment banks looking for distribution, which is very challenging. I think it's needle in a haystack. And then there's issuers who are able to leverage some of these exemptions and technology to build that themselves, to build their own platform and take advantage of the different ways to build a sales force, to incorporate marketing strategies that are working well. And that's really what our approach has been.
Okay, so that's very helpful. Provide some perspective, for doing a debt offering online. Just so everybody's aware, with Reg CF, you can raise up to 5 million online. Reg A up to 75 million, and Reg D unlimited. But for Reg D, you have to be an accredited investor. There are different requirements for each type of offering. We're not going to get into that today, but I do want to ask Ben and George this question right now, because I think about getting a small business loan. You go to the bank, you sit in a couch, you wait for somebody to call your name. You go over there and say, hey, I need X amount of dollars. And they give you a stack of papers to fill out. And they say, you also need to bring this information back to me. And then maybe a few weeks, I don't know, months, however long, they say yes or no. I think one of the benefits of raising debt online is the efficacy, the speed of decision, and the ability not to have to sit in a queue in a bank someplace, which I don't think anybody really wants to do. So how is it similar and how is it different in raising debt online and getting a loan on your platform? And I want to start with you, George, first.
Yeah, certainly, and I think there's some similarities and some differences, right? So Honeycomb, it's an all online loan application system, and there's gonna be dimensions that we ask for that are very similar to a bank. Some of that is because of SEC requirements and what needs to feed what's called the Form C, basically a lightweight investment prospectus on every single deal. But some of that is also part of Honeycomb's own diligence process, where we try to go above and beyond and make sure we're vetting the businesses that come onto the platform. So our online application system is going to pull in past years of operating history, tax documents, business plan. We're also going to do a credit check on every business owner. We do anti-money laundering and know your customer and bad actor checks on all of our businesses as well. All of that happens online in real time. So if a business has their financials together, they have their business plan together, we're seeing an average application can be 15 minutes or less. If they don't have those materials together, obviously it can take substantially longer. And then from there, we typically turn around terms within 24 hours. So I know with a lot of banks, their lending committee might meet once every week, once every 2 weeks. Maybe there's additional questions. They come back and say, hey, we had a question about this thing. It can be a lot of back and forth. And as Ben alluded to earlier, that can create a lot of heartburn for business owners because the process can drag on and on and on. We were hearing that an average SBA loan can take between 6 and 9 months to fund. And there's a lot of uncertainty in that timeline, right? You don't know if you're going to get the funding until the end of that 6 or 9 months. With a Honeycomb loan with Reg CF, the timeline is a fraction of that. We're about 3 times faster than a typical SBA loan at this point. And yeah, so there's some similarities in the overall documentation we're capturing. But I think just as agile technology companies, we're able to act on that information much, much faster.
So, you're doing diligence that's similar to a bank, but you're doing it faster. You're doing AML, KYC. Everybody has to do that. Are you running credit checks? You're calling up Experian and saying, "Hey, these guys good."
We do run credit checks at Honeycomb. We have a credit score cutoff that we won't work with. So we have kind of a fully defined credit policy internally that we use as a benchmark to set guardrails on who we allow onto the platform and who we don't. So that way we're making sure we're treating all potential borrowers equally.
Okay. Ben, what about you guys? The small business loan, I imagine it's similar. How do you guys manage this?
Yeah, so we built a risk model initially that just kind of modeled the risk-weighted metrics of the SBA loan risk model. We wanted to try and get as good a performance as the SBA, and maybe a little better. And then as we've seen more and more businesses, obviously see thousands of businesses every year, we've iterated on it a little bit, and maybe look for a few things that banks don't look for as well. But at the end of the day, if I get 4 pieces of information from a potential issuer, then I can give them a preliminary approval that about 95, 97% of the time is going to hold once I get the additional documents. Because people just want to know, like, is this even worth doing? I'll go to my account, and I'll work my account, and I'll clean up some stuff. I'll do whatever's necessary. I just want to know whether I'm going to get approved. So I could send any potential issuer, a link right now. They could click on that link, upload 4 documents, their 2023 P&L and balance sheet, 2024 year-to-date P&L and balance sheet, take 1 line, write what the use of funds are. It's going to drop on my underwriter's desk immediately. And like George said, when he comes back from lunch or 24 hours later, in about 15 minutes, he's going to be able to give us an approval. And then once the issuer signs the letter of intent, now we're going to drill a little deeper just to make sure that there haven't been some issues. Some of it, like George said, is SEC. You can't have someone that committed a securities violation, listing a bond on the marketplace. That would be unlawful. But there's other things you just want to make sure, because we're a 2-sided marketplace, so we're not just responsible for getting the issuer their money. We're making sure that the investors are as safe as possible, insofar as it's in our control. So just like George, we take investor safety, real seriously, and you can do that all along the way, but you definitely want to do it up front at the due diligence level. And we turn away more businesses, frankly, than we approve.
What's your approval ratio? Is it like 50-50 or?
I don't know if I can disclose that just yet without getting in trouble with my
Okay.
Underwriting team. But we see a lot of applications where the fit's just not quite right, and maybe they're just a little bit early, and they need to go out and execute their business model and come back to us 6 months later. And we see a ton of businesses that end up doing that.
And so, term, size, rates. What are your rates range? How do you compare with the local, SNL or bank?
So we, like everybody who is pricing the cost of capital, should take into account both what rates are from the Fed. So we benchmark to Fed rates. And then there's a range of rates based on the risk profile of the borrower. Obviously, the longer you borrow, the riskier it is. The risk-weighted metrics of our risk model will tell us something about the risk profile. You're creating a risk profile of the borrower, just like anybody who's pricing risk should do. Whether you're pricing an option in some derivative or whether you're pricing a loan, you should be pricing that risk. And you want to get as accurately as possible, because at scale, if you do it right, then any losses should be offset by the gains. You know, if you're pricing risk, we can't promise that, but that's the goal. So today our rates are between like 9 and 12%. They've been lower than that when rates were lower. If the cost of capital goes up, then the cost of capital for SMBX goes up as well.
Okay. All right. And term 12 months,
We've
36.
had businesses borrow for as little as 1 year and as long as 7 years.
Okay. Okay. Interesting. George, how does Honeycomb line up there with your rates, terms?
Yeah, fairly comparable. So typical loan size, our sweet spot we say is 25,000 up to about 250,000. Our average right now is a little over 60,000. Terms, interest rate, we're typically prime to prime plus 6. So kind of a little bit wider band maybe than SMBX. So rates are anywhere from what is prime now, 8.25 up to 14.25, 14.5, somewhere in that range. And then the typical term is 3 to 5 years. We sometimes will make exceptions and do 7-year terms as well.
Okay. All right. Interesting. Eitan, I know that you do, I think you're doing mostly Reg A's, Reg D's. You're doing some Reg CFs. You have the capacity and the ability to issue like a small business loan. I don't know if that's a market you're targeting or not, but from the debt offerings that you're seeing today, how does that compare or contrast to what SMBX and Honeycomb are doing?
From a rate perspective, in this lately, it's been 7 to 13%. And from a duration perspective, it's 1 to 10 plus years amongst some different issuers of ours. Some offer, multiple durations that aim to return, different returns based on that duration. It could be backed by, these are loans backed by real estate, backed by, in some cases, small business loans. In other cases, oil and gas interests, et cetera. But generally the same range.
And are you doing a lot of Reg CF debt offerings now, or it's just mostly Reg A?
We're not doing a lot of Reg CF's debt offerings right now. It's mostly Reg D and Reg A.
Okay. All right. Yeah. So you kind of inched into the other side of the coin. So you have an issuer, a borrower that needs money, and doing this online, having a process is faster than you would have with the bank. It's almost like peer-to-peer lending 3.0 is awesome, but then there's the investor side. And so I want to talk about this a little bit. I was saying earlier that as I get older, I start to get more risk averse, and so I'm looking for income and not necessarily huge capital gains, as exciting as it can be. Eitan, I'm going to stick with you. So I buy a debt offering on your platform. What type of returns can I anticipate? What type of do you have a default rate with these? I mean, what's the benefit here if I'm like investing in a debt offering on your platform?
So this would be platforms that we power and support through our broker dealer. So from a regulatory and compliance perspective, and also through technology that we provide to issuers, again, to set up their own platforms, generally in a fund structure who then issues bonds or debt-related securities. And like I mentioned, typically the duration is somewhere between 1 and 10 years. And the anticipated return, or the projected return, is typically somewhere between 7 and 13%, depending on the issuer. Yeah, I mean that's what we're seeing mostly. We're not working with clients that are looking to raise like a one and done $50,000 or $100,000 loan through Reg CF. It's more perpetual issuers, fund structures, that are looking to raise ideally millions per month on an ongoing basis. And we're showing them how others are doing that, both through technology, automation, through really efficient marketing strategies, the ability to track the analytics, so they understand how much, the return on advertising spend for each of their investors. But on the Reg D side, the investment minimums could be 25,000 and 50,000, 100,000. You have some investors that are allocating multiple hundreds of thousands or even millions of dollars to yield generating opportunities. Distributions could be made on a monthly basis, right? So it's important for the technology to have that to give issuers that ability to set when they want to make distributions. Investors sign up for a platform, they link their account, they read the disclosures, they might choose to participate or to speak with a salesperson at the issuer. They make an investment, and then the idea is to provide them with, with distributions in an automated way. So that's the typical profile of debt issuers. Many of them start with Reg D, and then we give the ability to expand that to do a side-by-side Reg A, right? So now they could accommodate the needs of the other 90% of the investor population that isn't yet accredited. And so, but all on the same technology provides their investors with a unified brokerage statement dashboard that where they could track all the different investments that they made, and receive, link their bank accounts to receive the distributions in an automated way. But that's probably the fastest growing sector that we're experiencing. These are perpetual. We have one issuwer that offers, I think it's 7% now, that's raised over $200 million in just through Reg A alone. We have another Reg D issuer that's also done a number of Reg A's that's raising consistently over $15-20 million per month, right? That issuer has a number of registered reps that are registered with Dalmore. Again, that allows for them to turn their salespeople into a captive sales force to sell securities. They could then talk to investors. They could perform compliant webinars, right? And develop that relationship with investors who hopefully will continue to make increased investments over time. But it's an exciting part of the industry, and we're really focused on that.
So that's interesting. Do you see from your point of view, do you see a lot of repeat investors that they invest again? And then
these are people that they might be making 4% or less in a bank account, and they see an opportunity to potentially double that or triple that in some cases. Obviously, there's risk with every investment, but there's the opportunity for issuers to develop their own reputation through delivering to investors, right? To communicating properly, to having pleasant technology and comprehensive technology to make the investor experience efficient. And then the best way, many investors will start with a smaller investment, see how it goes, make sure that they're getting their monthly distributions, and then consider increasing it going forward. Hence the perpetual issuer nature of the types of clients that we're really accustomed to working with.
And I guess that's what everybody would like to see, because like big corporations, that's what they do. They issue debt on a rolling basis. When it comes to term, they raise more money to buy it off, and they move on to the next one. They refi. And I would think that your three different platforms would want the same, because once you have an established relationship with an issuer, then it's easier because you know what to expect. You have some insight and some knowledge as to how they're going to perform, and that's important for investors as well. So anytime your tech stack allows an investor to go into your web to your a window and manage their money and see everything that's going on and deposit and remove and just like a brokerage, right?
Yeah, it's really everything. It's designed. It's really all in one. They have all the tools and the regulatory approved workflows to enable an issuer to have a white label portal to leverage all the different exemptions, Reg CF, Reg D, Reg A in one, and have all the required components built into that portal, like payment processing, like KYC, anti-money laundering, suitability, all with compliance overseeing the entire process, doing the diligence, reviewing and approving each investment, integrated transfer agent and cap table management, that allows to issuers to be organized and have control over their investor group, make distributions, and then just keep driving more traffic and on the marketing side and the promotion side.
Okay. So George, again, you're a little bit different here because a lot of your clients are Main Street businesses, and I'm going to assume that many of the investors are people that use the business. They're customers of your client, and that can have a multiplier effect, I would think. So let's talk about your investors, how that process works for them, and how does that work for the issuer?
Yeah, certainly, and you're spot on, right? So most of our small businesses, these are Main Street small businesses that have direct ties to their customer base. And part of the Honeycomb experience is empowering these businesses to be able to activate their own customers and fans to support their small business through the investment vehicle. And that's important for a couple of reasons. One, we actually view it as part of our diligence, right? Harping back to my community banking days, I don't know if the sushi restaurant makes a good roll. I have no idea. But if someone in the local community is there and goes to the restaurant and knows the owner and knows the quality of the product and they vote with their wallets, that's a really good sign that the company, the small business, is doing something right in their local community. And we view that as a really important part of kind of this broader diligence of that knowledge of the crowd. So what we find is about 70% of the investors are typically from the community where the small business is located. And then what we're finding is people are starting to earn nice returns, right? Maybe I invested in my favorite coffee shop and I got paid back and I saw like, hey, look at this, I'm earning a nice return well above the market. Maybe I should check out other coffee shops, or maybe I should check out other small businesses in my local community. Or maybe there's a geographic community that's important to me, or a demographic group that's important to me that I want to put money to work into. And we're finding a lot of our investors are then becoming power users on the site and coming back and building a portfolio of loans through the small business, through the Honeycomb platform.
So they can log in, an investor logs in, and they actually can see their portfolio, they can see their returns, they can take that money, they can remove it, or they can say, hey, this is another business I like, I don't know anything about it, but it sounds cool, there's a lot of other people backing this, I'm going to invest my money in that too at the same time, right?
That's exactly right. Yeah. So investors get paid back into a Honeycomb wallet, and they can distribute those funds at any time. Of course, take it out to their own bank account, go whatever they want to do with it. Or it's really easy just to roll those funds over, right? So every offering on the Honeycomb platform, as every Reg CF platform, gets its own offering page, a video, a write-up about the business, obviously the Form C and kind of the diligence materials. So investors can log in and do as much diligence as they want to do. And if they like the business, they like the mission, they can roll those Honeycomb wallet funds into another offering if they decide to do so.
Did you partner with a bank on the accounts or the wallets, or do you do that in-house?
We're working with a third party to manage the wallets. Yeah.
Okay. All right. That makes sense to me. What about you, Ben? What's the type of investor that's coming to your platform? Are mainly customers, funding these loans? Are you seeing a lot of repeat investors? How's that developing at SMBX?
Yeah, it's similar to Honeycomb's experience. You want to identify a business that has what we call a fanatical customer base or a high belovability factor. We don't know if the business, makes great food, but we can evaluate the health of the business, like the financial health of the business. Likewise, the investors and the Instagram followers of that business, they don't know what the finances look like. They know they love the food of that business, or the beer that brewery makes, the shoes that children's shoe company makes, and so on. When you put those two together, we believe you get good underwriting. You can evaluate the financial health of the business plus the belovability factor, which, believe it or not, you can metricize that in kind of a more hard numbers way. You can metricize the belovability factor of the business. And then You have investors who come, every investor on the SMBX, almost every investor came for one business. But like George says, as they hang around, they get their principal and interest back over time, they start becoming a repeat investor. On SMBX, about 50% of our investors are repeat investors, and
Okay.
their LTV, their lifetime value of investment, continues to go up and up and up. The average buy order stays about the same, but their average annual investment is going up. And for us, that's a really good sign, because it means we're adding value to those investors' lives. Initially, it was all retail investors who were customers of the business. Over time, we've had a couple smaller financial institutions, a couple single family offices. We have one CDFI that's trickled on and starts to make bigger and bigger buy orders. And we expect at scale that we will start to get a happy synergy of both retail investors and financial institutions making bond purchases. So that's what we would expect as we move closer and closer to trying to be more of a capital marketplace for small businesses.
Yeah, it's still very much early days, and you kind of see this evolving over time as you guys learn and scale. I find that very interesting. Eitan, I think what you should do is you should like buy these loans and create a fund, securitize these loans, and then turn around and sell that just like everybody else does. I think that would be awesome, because that would provide more liquidity for these two guys to make more loans and reduce their risk overall. That would be really cool. So scale. I a big thing for me is, for this entire industry of online capital formation, is scale. How do you scale? And back in the early days, many people were saying, well, this creates an awesome opportunity for smaller investors, retail investors, to participate in the private securities markets. And I think that's great. I think that's a really good thing. It's always been my opinion that to get really to where it can and should be is you need to engage with more institutional type money alongside retail, alongside smaller investors, and frankly, on the exact same terms. And, Eitan, am I off base? Am I heading in the right direction? Are you guys going to do this? What are you seeing from your vantage point?
That's the plan, right? Look, RIAs, institutional investors, are not going to participate or direct their clients to participate in a one-off $100,000 loan to a company. They may consider allocating to an issuer that has a $300 million fund that has a track record. So there's different segments of the marketplace. Ultimately, I think the biggest opportunity is to bring more order to a generally disorganized private securities industry. And the private capital markets, I think, are bigger than the public capital markets. There's just not a lot of order. So there's the crowdfunding approach, which is, leverage your community, leverage your followers, be able to market and promote in a compliant way, and it really relies a lot on marketing and communication in that way. There's another way, once you're larger and more established as a fund, to also leverage marketing, but also to deploy some other strategies. Again, like having a captive sales force, people that could talk to these larger accredited investors, salespeople that could talk to RIAs who are considering allocating to this type of strategy. But that's the big opportunity. It's really bridging the gap between the production of these private alternative investment opportunities or debt opportunities and the insatiable demand from institutional investors for higher potential yielding investment opportunities. But it's not a fit for every type of issuer, right? It is your idea of consolidating this into a more consolidating a lot of these smaller loans into more of a fund structure to give diversification is interesting, and I do think that is something that is going to work over time. But in the meantime, we're really busy with bond issuers, with debt security related issuers, and who are building their own platforms, who are where they're leading investors not to the opportunity to invest in multiple deals, but only in their own deals. Right, so they're really kind of keeping that relationship very tight, communicating properly, and hopefully delivering and paying out distributions, and that just keeps growing, right? But ultimately, yes, I think it's going to result in more institutional participation.
Yeah, no, I mean, I'm appreciate your perspective there. I think that's very interesting. And as I said earlier, private debt markets or public debt markets are huge, but private debt markets are enormous too. And I was reading earlier today that they stand about 1.5 trillion annually now in the United States, and that's expected to nearly double in the next couple of years. And I can foresee this as providing an access for the smaller investor to tap into something that's typically the realm of the very wealthy and the hedgies. Maybe I'm getting ahead of myself, but I like that. I like that trajectory. George, am I Looney Tunes? Am I off base? Should we involve institutional money on Honeycomb? Do you foresee that in your future? And if so, how is that going to manifest itself?
Yeah, absolutely. And we already see it, right? So we already have a number of institutional capital partners actively investing on the platform. Most of them are pretty impact aligned. So as you can imagine, the types of businesses we're serving are tremendously diverse. If you look at businesses in low to moderate income communities, women-owned, minority-owned, or veteran-owned businesses, it's almost 90% of the businesses we work with are in one or multiple of those buckets. So it's just an extraordinarily diverse group of business owners that we're able to work with. And so there's a lot of organizations who are obviously looking for a return, but are also looking for specific impact metrics. So we have a number of foundations and CDFIs with place-based investment strategies who are putting money to work on the Honeycomb platform. We view that as the entry point, right? Kind of getting aligned impact capital and proving that they can earn a competitive return on the platform while meeting certain impact goals that they might have. And if we can prove that, then I think there's a lot of opportunities for us to move upstream. And I think one thing to call out that we want to be really careful about, you alluded to this being kind of peer-to-peer lending 3.0. I think, if you look at the 1.0, you look at the lending clubs and Prospers of the world, the joke is that they went from being peer-to-peer to peer-to-hedge fund, which is a totally fine business model, right? There's nothing wrong with being a loan originator that sources loans for private markets. But that's not the vision for Honeycomb, right? We don't want to crowd out retail investors because we believe that those retail investors are bringing knowledge to our platform. And so when we think about layering in institutional capital, we always want to think about it as additive and topping off the offerings, making sure small businesses are fully capitalized, and eventually allowing us to move upstream and do larger offerings over time, and not replacing retail investors with institutional, but rather complementing retail investors with institutional.
Yeah, 100%. I mean, it's my personal opinion is that the ecosystem should encourage retail participation, and that retail or the smallest investors have access to the very best opportunities available, as opposed to the afterthoughts and just public markets. And I would like to see policymakers pursuing that instead of saying, hey, these people, it's widows and orphans, they're going to lose all their money. They need to say, hey, how can we enable this, empower these individuals to participate in these offerings and do it in a safe manner? I also think it's an area where you should, or we should be providing, certain tax exemptions to encourage it from both the investor, small investor side, as well as institutional money to support these smaller firms, to support these small businesses that are in need of either equity capital or debt capital. I think that's where it should be heading. Ben, I think I'm preaching to the choir here right now, because you're kind of a mission-driven platform, and you've already said that you're working with some outside money that's more institutional. How's that going?
Yeah, it's great. I mean, like I said, it's what we would expect to see in the evolution of a capital market. Think of like a young child that's just been born and it's growing. It's going to have new capacities as that child grows up and matures, that they didn't have additional athleticism, additional flexibility, new skills and capacities. So we just see it as where we're at in the growth of the marketplace. So I will add, though, that not all retail investors have the same kind of interests. So like we have people who spend a lot of time looking at the socials of one offering. They may even go into the bakery and buy something, and really it's like a hobby of theirs, and they really enjoy the process of slowly sifting through offerings and picking ones that they think are good investments. But we've got other retail investors that live next door to them who want to just get portfolio diversification out of the box. And so if they were given the option to have part of their retirement account earmarked to 1% for investing in San Francisco owned businesses or DC owned businesses or Black owned businesses, they would do it in a heartbeat. So as we, enjoy the process of scaling up and really focusing on identifying, good borrowers who can perform and making sure that investors get, as much of their investment returned to them, I think we'll want to start to think about how you can adhere to the traditional principles of portfolio diversification. And if you can do that, then you're going to be in a really good place to succeed. Because retail investors doesn't just mean one thing. I mean, right now we're all retail investing in a passive way through our retirement accounts and other investment vehicles, or even on our bank where our money is being stored in a zero interest bank account, and the bank is taking it out and lending in the form of mortgages and C&I loans and so on. We're all directly investing right now our capital. The question is whether we're actually getting the return on it or not. And so, what these...
Yeah, I'd love to do some beat down on some banks, because traditional banking is a great industry to hate.
Well, yeah, I'm not hating on. I'm saying that's the way the business model.
I will.
Business model, how it works. We store our money there. We could equally store it in a diversified portfolio of small business bonds or loans in the community. As well.
Yeah, awesome. So I think I foresee the path where we get some institutional money and you guys originate the loans, and then Eitan comes and he securitizes these bundles and he sells them on Wall Street, and everybody goes away happy, right? Isn't that how that works? So we're running out of time here. We got a few questions I'm going to try to hit really quickly. Some of these I understand, some of these I don't. The first one I'm going to ask for George. It says, so I want to use an SBA 504 loan to acquire land and build commercial real estate in an opportunity zone. Would you guys be able to replace that SBL loan with an offering listed on your site?
So we oftentimes work side by side with an SBA lender on real estate. We don't typically do real estate loans ourselves, mostly just because our longest term is 7 years, and with an SBA real estate loan, you can often go longer than that. So just from a debt service coverage ratio, we often find ourselves, if someone's buying land or buying a building, we come in and do the furnitures and fixtures, or we come in kind of side by side and play nice with the SBA lender. But oftentimes for a land purchase or a building purchase, an SBA loan typically works a little bit better, just simply because investors in the platform aren't used to putting their money out to work for 10, 15, 20 years. So it's a little bit harder to sell the community to get people bought in on such a long-term asset.
SMBX, what about you guys, Ben? Would you guys do that?
If the maturity was going to be longer, our investors aren't interested in keeping their money tied up for 10 or in some cases 30 years, right? Some of those CDC 504s can be quite long. And usually the bank that's giving that out are doing that to not make money so much as to preserve the banking relationship with the borrower themselves. So yeah, we probably wouldn't be the right fit for that. We typically work great as a substitute for a 7A SBA loan. Someone who would take out a 7A SBA loan but doesn't want to tie up the collateral in their house, is experiencing a friction-filled process, doesn't want to wait 9 months.
SBA loan. What is? I don't know what that is.
It's just the style. It's for somebody who's growing. Somebody who has 2 food trucks that are working and wants to borrow $300,000 for a 3rd food truck. Someone who has been in business for a couple years and is still figuring things out, but has the ability to grow the business and is serving their community well and needs a little bit of operating capital. Someone who took out Square loans and credit card loans to grow the business and now has $50,000 that they're paying, you know, a crazy ARR on, like 20% or something like that, and wants to refinance that.
You guys are way better than an MCA loan. I mean, yeah.
Yeah, correct.
Yeah. Awesome.
MCAs are nuts. People don't understand how absurd the interest rates are on a merchant cash advance. And yes, so especially if it's some sort of asset purchase, strongly encourage people to check out SMBX or Honeycomb if you're thinking about a merchant cash advance.
That sounds like good advice to me. Hey, Todd, somebody was asking about the regulatory implications on crowdfunding versus traditional lending. Really, there's none, right? Eitan?
The regulatory consequence? What was the question? Sorry.
The implications, the regulatory implications of raising money online versus, you know, more traditional. It's the same.
Well, I don't know if it's the same. It depends on which exemption you use ultimately, but it's definitely an alternative. It can be done in conjunction. If someone is able to efficiently raise, you know, capital at a low enough rate from a bank, then they should. But oftentimes, you know, post Dodd-Frank, it's not as simple to call up Chase and or Bank of America and talk to a rep there who's going to understand and what you're looking to do and guide you accordingly. I think, you know, platforms that Ben and George are running really focus specifically on that, and that could be really helpful and could save a lot of time for those looking for loans of that size. You know, but I think in general, I think the regulated crowdfunding portal industry it's been struggling a bit. Many of the platforms are not cash flow positive. I think if you are, as a platform, if you remain too general and you bring forward to market all different types of issuers with different types of structures doing different types of things, it's been a recipe for disaster from my perspective when you really observe what's going on. Whereas the two platforms on our that join us today are doing something very different. They're specializing in something. It's rinse and repeat. It's value add. It's easy to understand, and I think it's ultimately you know is very additive to the economy, and I think makes a lot of sense strategically. So I think that's the future of where the crowdfunding industry is going to go. It's not going to be like the equivalent of a Kickstarter or an Indiegogo for rewards crowdfunding, where you're just going to post anything depending on whatever valuation, whatever structure, separate diligence processes for each one. I think something streamlined, like we're seeing here, is certainly very intriguing and scalable.
Yeah, no, I mean, I think that there's a lot of opportunity here today, and it's still very much in its infancy. And we have three, trailblazers right here, right now that are pursuing a very viable market. I have no idea, where it's going to be 12 months from now or 5, 10 years from now. So we're out of time. I'm going to ask each of you to kind of, predict the future for online capital formation when it comes to debt offerings, and ask you really quickly, what you foresee down the road. I'm going to start with you, Ben.
Okay, so I think you're going to see a lot of equity crowdfunding portals and funding portals in general. They raise that seed capital and they'll get stuck between seed and Series A, because seed is all promise. Series A is you actually have to demonstrate the viability of the business model to raise it. And a lot of them are just going to shut down. Some of them are shutting down anyway. So expect to see a fire sale for these licenses that were very difficult to get, and only have value if the business model itself is sustainable. But the flip side is, if you can embrace the traditional dynamics that are tried and true in how a capital market functions when it's in equilibrium and growing beneficially for the actors populating that capital market, whether it's a CPA, an investor, a business owner, an underwriter, an RIA, an investment banker, a broker dealer, a custodian, and so on. If you really can honor the way that a well-functioning capital market works at scale, adhering to the principles of diversity of portfolio allocation, maybe even have a liquid derivatives market, having liquidity, have financial institutions monetizing the liquidity as a service that they provide, and so on, so that the retail investors can go hog wild and act as as unpredictable as they want to act without throwing the mechanics of the market off. If you really do honor the way capital markets work and you try and build that for small businesses, I think you're going to have success. I see George and I both trying to do that. It's not easy, and yet here we are. And so just, I would say the third thing is just feeling really honored to be in this position, to be able to build, and hopeful for the future for the customers, the communities we serve.
Yeah, the technology is just going to get better and better and better, and people are just going to continue to iterate and innovate. George, what are you seeing 12 months and 10 years out?
Yeah, I will agree with everything Ben just said. Maybe I'll think about it more from the competitive landscape. I don't see any world where Wells Fargo remembers how to lend to small businesses again. Or Chase, Jamie Dimon wakes up tomorrow.
Did they ever know how?
Right, we're doing small business loans again, right? That's not the direction the market's been moving. This has been a multi-generational, multi-decade movement that banks have been retreating from small business lending. I mean, the fact that SBA loans are subsidized at an 80% rate by taxpayers and banks still won't lend to small businesses, that's telling you that there's something going on here, and that tide is not just going to turn around overnight. So completely agree with Ben. Like there's a growing white space here, and if you can build a market solution that truly clears the market in a thoughtful way, there's tremendous opportunity. And I think in the coming year, in the coming decades, that white space only continues to grow. Now it's getting to that scale, it's getting to that level that we're building sustainable platforms to serve that need. But I'm obviously a bull on regulation, crowdfunding, and community-based capital options to fill the gap left behind by banks.
Yeah, and part of the problem is our policymakers typically don't even understand this at all. And too many of them are attorneys and not small business people. Eitan, you're going to put all this together. You're going to take these bits and pieces, and you're going to be the market maker, aren't you, for all of this? What do you see coming in the future?
First, I think it's challenging for regulated entities to do small deals. How do you make money charging 5% on a $100,000 loan with the regulatory and compliance risk and oversight? With the friction, oftentimes with these with borrowers borrowing for the first time, so there's a lot of education that goes into it. So I think as things scale, I think the creation of funds that may be offered that maybe offer a kind of a diversified pool of these loans is something that I could see trading. Eventually, I could see market makers being involved. I could see there being more RIA and institutional interest in. And that's when things get, I think, really interesting. And so, but as far as the future, from an issuer's perspective, you need to be aware of all the different tools that you have at your, all the resources and tools that you have available, right? The technology, the ability to access these exemptions, the ability to build a captive sales force to assist, and the know-how as far as strategy and marketing and promotion. These things all come together and are all required, to launch a successful offering. And that's really what we've been observing over the last number of years, and have really refined our approach, not as much focused on one and done small Reg CF offerings, more so allowing more established issuers to utilize Reg CF, but more so we're moving in the direction of larger funds, a bit more upstream, really, in hopes of bridging that gap between, again, the production of these private securities and the potential consumption of those securities. So not just the base of investors, the retail base of investors that are associated with the issuer or who they market to, they do that as well, but you really have to diversify. And so I would say that anyone that's out there looking for debt on an ongoing basis, or is looking to issue debt or offer bonds, I think we could be pretty helpful. And I would encourage you to contact us to talk about that.
Yeah, that's awesome. I'm very optimistic about the future. It's just a question of how long it's going to take to get where it can be. So we're out of time today. I want to thank the panelists once again. You guys are awesome. Thank you, Eitan. Thank you, George, and thank you, Ben. And I want to thank everybody who's viewed this webinar. We're planning our next webinar for October, and we're going to do another interesting session. It's going to be about how to ensure a successful offering online. So hopefully we'll see everybody there. Once again, my name is Andrew Dix, and I am the founder of Crowdfund Media Group. And everybody have a great day and take care, and we'll talk to you soon.